welcome back. I am Moumita. In today's episode, I will be talking about all the important economic and financial indicators and events which were released last week. Let us begin. Let us talk about Russia. The exchange rate of Russia, the ruble, is recovering. Since the beginning of its war on Ukraine, the Russia's exchange rate had fallen sharply. It had touched a low of almost 121.5 to the dollar. In a major policy move, the Central Bank of Russia has pegged the ruble to gold. 1 gram of gold is currently pegged at 5,000 rubles. This has helped restore confidence in the currency, and the exchange rate has now recovered to around 80 rubles per dollar. Pegging the exchange rate with gold is known as gold parity. This kind of system was widely prevalent after the Second World War. In the Bretton Woods era, the dollar was linked to gold. In the late 1960s, there was a war in Vietnam and the US expenditure was on the rise. People became anxious and nervous about the dollar's value and they wanted to exchange it for gold. The president of US then, Nixon, was worried that the economy would run out of gold this week. He finally ended the convertibility in the year 1971. Russia could end up in a similar situation like the US had done in 1971. Moving to China, China's foreign exchange reserves have fallen by around $26 billion in the month of March. This is making news because it is a large number. There has been outflow from equity and bond market. Russia's invasion of Ukraine, China's own problem, which is the rising number of coronavirus, the zero COVID policy, all are contributing to this kind of outflow. This is also reflected in the sentiments. Last week we had discussed about how the official non-manufacturing PMIs had slowed down. In the previous week, the Kixin PMIs also showed that there has been a slowdown. The Kixin Services PMI focuses on small firms in the coastal regions. It shows that the business confidence is almost at a 2-year low due to the mobility restrictions. The sectors which are most hurt are the contact intensive sectors like transportation, hotel, and catering. Moving to Euro area, the monetary policy meeting minutes were released last week. The minutes of the ECB monetary policy meeting, which was held in the month of March, was released last week. A number of the ECB members are pushing for a firm end date of its bond purchase program. However, some members want to wait and see. The members want to understand the economic impact of Russia's war on Eurozone and not tighten prematurely as a sudden rise in the rate may push the economy into recession. As of now, the bond purchases are likely to end in the third quarter of 2022. Any increase in the policy rates is likely only after the bond purchase program comes to an end. Moving to US, the monetary policy meeting minutes. The monetary policy meeting minutes of the Fed was released last week. This was the meeting held in the month of March. The Fed will be shrinking the balance sheet at a faster pace than it had done in the past. Just to put it in perspective, Fed has said it will be reducing its bond holdings by around $95 billion per month. Back in 2017, the reduction was around $50 billion per month. It means that liquidity will not be easily available as it was in the past. The Fed also wants to increase its policy rates quickly now. There were hawkish signals given by President Bullard, who said he wants to see the rates at 3 to 3.25% in the second half of 2022. The Fed is reducing the balance sheet and increasing the policy rates to tame inflation, and also because the employment market is showing that the economy has a lot of resilience. Moving to India, the PMI numbers were released last week. The manufacturing PMI slipped a bit in the month of March. However, it still remains above 50, which means that the economy is still in expansion mode. There has been a decline in new orders. Input and the output prices are continuing to rise. However, demand continues to be strong despite the rising prices. If the prices continue to rise in the next few months, demand might see a slowdown. On the other hand, the services PMI improved in the month of March. Despite the rise in input costs, the demand for services continued to remain strong. The RBI monetary policy meeting was held last week. This was the first policy meeting of the RBI in for this fiscal year, and it was also the first meeting since the war on Ukraine. The RBI kept all its policy rates, which is the repo rate and the reverse repo rate, unchanged in the policy meeting. The RBI also revised its forecast. It has revised down its growth forecast and it has revised up its inflation forecast. The new forecasts are based on crude oil at $100 per barrel. In the previous policy meeting, in the month of February, the forecast had assumed crude at around $60 per barrel, although it wasn't explicitly mentioned anywhere. In last week's policy meeting, the RBI also introduced the Standing Deposit Facility or the SDF rate. The rate is 3.75%. This rate will be the lower end of the Liquidity Adjustment Facility, or which is popularly known as the LAF corridor. Before the policy held last week, the floor of the LAF was the fixed rate reverse repo, which was 3.35%. So the LAF corridor, which is the difference between the marginal standing facility, which is at 4.25%, and the fixed rate reverse repo, which was at 3.35%, was 90 basis points. Now, SDF is the floor, so the difference between the marginal standing facility rate and the standing deposit facility rate, which is the SDF, is 50 basis points, which is the LAF corridor. The LAF corridor is the operating framework of the RBI. The RBI tries to keep the interest rate in the economy close to the policy rate by adjusting the liquidity within the LAF corridor. Why did the RBI change from the fixed rate reverse repo to SDF? In the fixed rate reverse repo, the RBI had to provide government securities as collateral to the banks. But in SDF, it is collateral free. This tool will help the banks to park their excess liquidity easily with the RBI, and they will also get a higher rate. The RBI, on its part, will be able to remove the excess liquidity from the system and keep inflation at bay. This is quite an intelligent way of the RBI to increase the rates in the economy without actually increasing the main policy rate, which is the repo rate. By pushing up the lower boundary of the interest rate, it is nudging the borrowing rates to climb up. This might also allow the RBI to avoid any increase in the policy rate in the near term. Thank you for listening. I am Moumita. Bye bye.